How can someone turn $5,000 into over $100,000? That's the question that's on everyone's mind. How can we be able to take a very small amount of money and be able to double it, triple it, quintuple it? How are we able to grow it in such a substantial amount in such a quick amount of time? Is that even possible? Because we see people, it seems like on Reddit and Wall Street Bets, that turn 5 grand into 50 grand and turn that 50 grand into 5 million, that 5 million to 55 million. How do people do that? Now, the thing is, I want to give you those answers, but we have to go over how options actually work for you to get a full understanding of this. So let's break this on down. I posted this over on my Twitter. Make sure you guys go check this on out, but let's read this together. It says, okay, option traders, I'm going to break down the way you should trade for consistent money and the way you can trade for YOLO bets. Now, these YOLO bets are not what I recommend. Yes, you can change your life, but changing your life could be for the better or for the worse if you guys do some YOLO bets. But let's talk about it all. So really, when you are talking about options, you only need to know these two things when it comes on down to making a lot of money. And that is going to be your strike price and your expiration. So once you learn these two components of option trading, you will figure out how to make big money. Number one is strike price. The easy way to think of this is the price you want to get to. When you set a strike price, this is your target. You want to get to the strike price and get above the strike price. So the farther out your strike price, the riskier your trade will be. The closer your strike price, the safer your trade will be. So far out of the money, which means you're very far away from your strike price, means you're going to have a lot of risk and your contracts are going to be extremely cheap. This is why they're so appealing to traders that have a very small amount of money. You could jump in on a stock, let's say like NVDA, and you can bet that NVDA is going to get all the way up to the price of 900. Now, 900 is pretty far away at this moment. That's $40 away. So those contracts are going to be very cheap. You could also say, hey, I think it's going to go all the way up to 1,000, and those contracts would be even cheaper. But the reason why they're cheap is because you don't have great odds that it's actually going to get up to 900 or 1,000. The cheaper the contract, it's usually because the more risk there is within that contract. Now, we can also go the other way around. The safe way to trade is to go barely out of the money or even in the money right away, which is what I do most of the time. This means I pay a little bit more, but I'm getting a contract that already has value. So instead of, let's say, only spending $2,000 on NVDA, I might spend $10,000 on NVDA, but my contracts have value right off the rip, which means, hey, I'm going to do a call contract, which means I am betting that NVDA is going to go up. I'm going to set a strike price at the price of 860. The stock is already at 863. That means I'm already considered in the money and my contracts already have value towards them right now. I pay a little bit more, but I know my contracts are going to produce. So when it comes down to stock trading, what you need to always understand is the more risk you're taking, the cheaper the contracts you're going to have. The more valuable your contracts are, the more you're going to have to pay. That's going to be the easiest way to think about it. When you have great risk, it's going to be very cheap and inexpensive, but when you have very minimal risk, you have to pay for that minimal risk. But that's what I like to do to have consistent profits every single day. Just like we had today, I was able to make $1,017, and while I'm not making $20,000 in a day, I'm making $1,000 a day because I'm paying for contracts that already have value right at the start. Number two is going to be our expiration. This is how much time you have to reach your strike price before your contract expires. Far away expiration means more expensive as you give yourself more time for success. Same day expiration means it's cheap as you only have today to reach your goal. So let's think about this. Our expiration is like an hourglass. When we have a huge hourglass and tons of sand and we are giving ourselves today, tomorrow, next week, next month, next year to reach our strike price, we are giving ourselves more time for the stock to get above our strike price. This means we have more time for success on our trade. Well, guess what? If we want to get that time, we need to pay for it. So if I want to have a very inexpensive contract, I might only do a today's expiration or a tomorrow's expiration or a this week's expiration. A very small amount of time and a very far away expiration is basically limiting your chance of success. Hey, I bet that NVDA is going to get up to the price of 900 by the end of today. Well, guess what? Those contracts are probably dirt cheap. You know why? Because the chances of you getting all the way up to 900 within the final 54 minutes of the day are slim to none. So you could be able to buy a ton of contracts for that if you would like to, but the odds are they're probably not going to work out and you're going to lose a lot of your money. So how are people making so much cash off options? Well, they do contracts like that and they end up working out. So imagine if someone did NVDA and they say, I'm going to buy 100 contracts. By the end of today, it's going to be up towards 900. And maybe some sort of big news comes on out and it starts ripping and running and spiking and climbing. Well, guess what? You bought 100 contracts for dirt cheap and now they have a ton of value behind them. That's how people are turning so much money from a little amount. But you need to understand, 99.9% of people that randomly do that just end up losing. So when it comes down to contracts, what you actually have to do is try to find that happy medium area. So as a day trader, I usually do 1 day out of expiration. I don't do the same day expiration. I do 1 day out. This keeps my contracts relatively cheap and I know that I'm going in and I'm only holding for 20 to 45 minutes max. Anything longer, I try to go out a couple more days or maybe even a week out, because you are going to come across something they call theta, aka time decay, which means the longer you hold your contract, the less value you have when you sell that contract. So you will be facing something called time decay, which is going to be, we will go over that into a different lesson, but that means the longer you hold, the less value your contract has as you're running out of time. So when I'm jumping in and I'm day trading, I'm usually doing tomorrow's expiration date and I'm only going to be trading and holding these contracts for about 20 to 30 minutes at most. That way I could still hold a lot of value in my contract, and on top of that, putting myself in the money is giving me value right away. So I save money by doing close expiration days, and I usually spend my money on the fact of giving myself value by putting myself in the money on my contracts right away. So when you guys see Wall Street bets and you guys see these meme traders and you're asking yourself, how in the world are they making so much? I saw someone turn $2,000 into $55,000 in a week. How did they do that? Well, they would do a play like SMCI. Someone might see SMCI and they buy contracts at the price of 400 and they put a strike price at the price of 875. So now you can see I'm giving myself a month and a half where I am putting a contract, a strike price in stratosphere. I'm jumping in right here at the price of 400 and I'm putting a strike price at 875. Well, let me tell you, you could probably buy 100, 500, 1,000 contracts for that price, basically saying in a month from now, I am betting that this entire company is going to go on a 100x move. Now, SMCI actually did. It went on this move and it went on this rip. So if let's say we wanted to buy one contract at this price, it might cost $5,000. But down here, it only costed you $50. So the thing is, imagine if you got 100 contracts, 1,000 contracts for $50 per contract. Now, they're all worth $5,000 per contract as we are in the current day in the current setting. Well, guess what? You were just able to make 100,000x your profit, and that's how people are able to make so much money. But the thing is, most traders go for these moonshots where they say, you know what? I think Amazon's going to do that next. I'm going to enter right now at 172 and I'm going to put a strike price at $400 by next month. Well, what are the cases? Well, in most cases, that never works out. In most cases, it doesn't happen. In most cases, that is not how you're going to be profitable. So I want to show you, how do people make tons of money? Well, they are going to be limiting their expiration and they are going to be putting strike prices in the stratosphere, hoping that they get hit before they run out of time. That is how these Wall Street bet traders are making so much money. But what is more of a consistent way to trade? More of a consistent way to trade is put yourself in the money, right at the money, or if you need to save some funds, slightly out of the money. And also, if you guys want to save funds, do not the same day expiration, but maybe the next day expiration, or maybe the same week expiration. And you are going to be able to get contracts for maybe only $500, $1,000, $2,000, something that you can afford, that's going to be more consistent, that is going to be relatively more profitable, because the thing is, you are going to just get on base. Let's think about this here, team. If I was a baseball coach and I was drafting guys, I am not going to pick 9 guys up that swing for the fences every single time and they strike out 9 out of 10 times and hit 1 home run. I would rather pick up a guy that hits 1 home run out of 10 times but gets on base 8 out of 10 times. I would much rather day after day after day make $1,000 per day rather than lose 5,000, lose 5,000, lose 5,000, lose 10,000, lose 20,000, lose 30,000, and then make a $20,000 return, right? I would much rather get on base safe and steady consistently rather than just going for the home run fences hoping for the best. But a lot of traders, and especially over on Wall Street Bets, they are going to be making much more crazy risky trades. So if you guys see a big earnings coming on up, if you just saw a big hot press release come on up and you have a little extra funds and you want to get a little crazy, obviously that is your free will and your decision. But the way that they do that and the way you can make the most amount of money is by going out extremely far on your strike price and hoping that strike price gets hit before your expiration comes on in. So find that happy medium, find what works for you. I do not suggest going on these crazy YOLO trades. I suggest having more consistent and safe trades, but I wanted to explain that all to you to make sure you understand how to be able to get those YOLO trades and be able to understand how traders are making this money and the risk involved with making those money.